What if the asset everyone's chasing is already overbought, yet remains deeply underowned? Bank of America's Francisco Blanch delivers his contrarian take on gold's wild run and shakes up how investors think about wealth protection right now.
Obviously, a little bit of a pullback. Love to get your take sort of on the year so far and then what we've seen in the last couple of days. And then lastly, what it portends for going forward. So give me a little past, present, and future prediction here.
Sure. So let me start. Thank you for having me. Let me start by saying that gold is both overbought but also underowned, and this means that you probably still want to own it in the long run, and that's why we've revised in the last couple of weeks. We revised our forecast by about $1,000 an ounce to 5,000. And but also, and again, we've been bullish gold throughout. We had a 4,000 target that just happened a lot faster than we anticipated. And the other thing that I would say about the gold market is that the extraordinary volatility we've seen on the way up, coupled with the declining volatility on the way down, makes us think that the market is, as I said, a little overbought right now, a little frothy. And we've seen massive ETF inflows in the past few weeks. So that's really what's triggered this last run up in August, September, and early October. It feels a little more retailish, to be honest. And again, there's fundamentals on gold. There's a big story of the fracture that we see in global geopolitics between the U.S. and China. The new sanctions that have been applied to Russia this week, and of course, there is a constant search by central banks for alternatives to U.S. dollar and euro-denominated assets. So that's been supportive of gold. But again, we think this market's a little overbought and it's going to be consolidating at these levels, maybe a little lower.
Really interesting. And so for a long time, gold was always sort of seen as a portfolio hedge, a reason to hang on to it. But is it more than a hedge right now? I mean, if in 3 months it's up 22%, do you think maybe the advice should be differing now for how you're looking at gold or why you should be including it in a portfolio?
Look, gold makes a lot of sense in a portfolio. So I think that's the first thing I would say. But also, I don't think it makes a lot of sense to try to chase gold prices higher. Remember, we've had a lot of volatility in a few corners of the market. We've had volatility in a number of equity markets. In particular, we've had volatility in miners. We had volatility in nuclear stocks and so on, right? So and perhaps also some of the AI stocks. And what's going on in the gold market is somewhat similar. We've seen silver also joining that rally. So I wouldn't be necessarily chasing it, but I would be buying dips and trying to establish a more formal core position in gold in a portfolio over time. Because I do think gold is money, and 50 years ago, 10 ounces of gold bought you a car, and today 10 ounces of gold buy you a car. So that's what you're buying there. You're buying some asset that over very long periods of time is going to more or less maintain its value. But I wouldn't be necessarily looking for gold to generate wealth for you. It's more of a protection against what may come.
Got it.
Whether that's the idea.
Okay. At first, I was going to ask if you think we're going to hit 3,800 before 4,500, but if your goal is 5,000 or your price target there for gold, I guess we know the answer. I'd love to move on to energy, oil specifically, while we have you here, because we've seen an awful lot of movement in WTI, and now we're getting these headlines that President Trump is looking to sort of open up that Arctic coast again for potential drilling. I guess, what do you make of that? What is your prediction for where energy is going to go as well, I guess, in terms of WTI crude?
Right. So we've been bearish oil the whole year, and it's been playing out more or less in that direction. There's been a number of hiccups. Remember, at the beginning of the year, we had outgoing Secretary Yellen impose sanctions on Russia on number 3 and 4, the number 3 and 4 producers. Those were Gazprom Neft and Surgutneft. And now we've seen President Trump going on against Rosneft and Lukoil, which are number 1 and number 2 producers in Russia. So now we have the entire kind of top echelons of the Russian energy sector under sanctions. This is going to reduce the amount of oil supply in the market. So that's the reason why we've seen a rally in prices, in crude prices, WTI and Brent. Brent's outperformed, and we've seen in particular near-dated contracts, those for delivery in December, rallying quite substantially because those sanctions going to play on November 21st. So if you're a refinery in India or in China, you have to rush and try to buy maybe some Middle East oil, maybe some European crude oil. and maybe some U.S. crude oil. So that's what's going on in the background. That's where we had the rally. Having said all that, nobody really knows how this is going to play out. Iran has been, despite the sanctions, been able to push a lot of oil into the market over the years. And the expectation is Russia will find ways outside the normal channels. So it could be 2-3 months where prices are a little higher. And in the meantime, remember, OPEC Plus is adding production to the system as we speak. They've added 2.5 million barrels a day in terms of quota increments, and they're adding now 1.6 million barrels a day. So we're not going to have a shortage of crude oil. We actually have a surplus, which I think is part of the reason the White House has moved with this. Yeah.